personal muted.
No PDAs, no cell phones, and log in with your own information and unique URL. You must be logged into the online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions that we will ask during the webinar, and you must complete the evaluation survey at the end of the webinar. Now I just want to give a quick overview of our presenters. Our first presenter is Dirk van Dijk. He's Managing Director of Valuations and Consulting at Armanino. He has more than 20 years of experience valuing technology companies in the Silicon Valley area. He has an ASA in Business Valuation, an undergraduate degree in Economics from Johns Hopkins University, and a Master's of Science in Business Administration from UC Berkeley. His key practice areas include tech company common stock valuations for option pricing, including purchase price allocation valuations for FASB ASC 805, goodwill impairment testing for FASB 142, and valuations for M&A, including shareholder buyouts. Our second presenter will be Mr. Scott Schwartz, Manager for Armanino's Equity Management Solutions. Scott has spent his career working in the professional services industry, serving public and private companies, as well as consulting entrepreneurs. At Armanino, Scott serves clients within our CFO advisory practice. He has conducted numerous stock and acquisition-related valuations and worked with our entire portfolio of equity compensation outsourcing clients. Scott has also worked with clients on issues related to stock-based compensation and other equity transactions, as well as financial modeling and process reengineering assistance. Finally, before we begin, I wanted to give you a quick overview of our learning objectives, particularly important for those of you trying to retain CE. During today's webinar, we're going to review the basics of 409 valuations and their importance in equity compensation. We're going to identify the stages of enterprise development and related valuation methods and typical equity awards. We're going to recognize the differences and similarities between common stock valuations and option valuations. And finally, we'll review strong granting practices and issuance considerations to avoid future audit, SEC, or IRS-related issues to equity compensation. And with that, I'll turn it over to Mr. Dirk van Dijk for our presentation overview.
Good morning. Today, Scott Schwartz and I will be talking about the stages of enterprise development and both the different valuation methods appropriate at those stages and the common equity award types granted at various stages of the company's development, the valuation process, as well as the equity granting process, and the impact of valuation timing on equity awards. So as the company achieves key milestones and advances through the stages of development, different valuation methods are appropriate and different equity compensation awards are often used.
So the question is, why are we talking about this? And most of this should be common knowledge, but obviously there's IRS impact related to common stock valuations, the biggest one being in relation to a liquidity event, but also option exercises and restricted stock vestings play into that. For audit and accounting, we talk about ASC 718, stock-based compensation we're going to discuss today. Also your EPS, your earnings per share, and income taxes can also be impacted by the value of your common stock and having proper methodologies behind that. Lastly, for company management, understanding what your company's worth at different stages of development and leveraging and understanding your compensation value of your equity. Should you be giving more equity, less equity based on the value of that equity to your participants? And lastly, maybe some management they want to know their personal wealth. They own a lot of equity in the company, and what is their personal wealth might also be a reason to know. Now we're going to actually go to our first polling question, and I'll turn it over to Debbie.
Thank you, Scott. So as I mentioned before, for those of you trying to attain CE credit, you're going to need to respond to 75% of our polling questions. There'll be 5 total throughout the webinar. So the first question is, how often do you have a 409 valuation done? A, we don't. B, annually. C, semi-annually. D, quarterly. Or E, whenever a major event occurs. We'll keep the polling question open for about 5 more seconds. 3, 2, and 1, please enter your answers. And I'll turn it back over to Dirk to give us a debrief.
Okay, so we have a variety of practice here. So it appears that about 38% get a 409A whenever a major event occurs. 26% get it annually. Interestingly, I see that 15% are getting it done quarterly. Perhaps those companies have a major event coming up, such as an IPO or acquisition. And about 20% of the companies don't get a 409A valuation done at this time. So interesting results, I would say. Okay, here we are. Our next slide, where we're talking about the guidance provided by the AICPA. In 2004, the AICPA issued a practice aid. You can read the title there, and to provide guidance. In 2013, just the end of last year, issued a new guide. They called this one a accounting and valuation guide, and it's focused on the fair value of individual common stock issued for equity compensation. And the stated goal of both these guidance by the AICPA is to clarify approaches, reduce diversity in practice, and to state, particularly with the 2013 guidance, to memorialize the actual practices taking place in the industry. Which brings up one significant change between the 2004 practice aid, 2013 valuation guide, is the addition of the back-solve method as an appropriate valuation method. Briefly, the back-solve method values the company and its common stock based on the per-share price paid in a recent preferred stock financing. And my last comment on the practice and valuation aids is that the IRS employees have stated in public presentations that the IRS expects 409A valuations to comply with the AICPA valuation guide. And if it does not comply, an explanation should be provided in the report as to why not. So that brings us to the impact of stages of development. A number of key valuation assumptions are directly influenced by this, including the time to liquidity, discount rate, which is driven by risk, and the valuation methods used. And also the selection of the peer group of public companies to use in calculating volatility and possibly develop valuation multiples is also influenced by this. An enterprise or business typically builds value throughout the various stages of development, but generally not in a linear fashion. And we'll go over this on the next slide. So this is a very early stage company. At neither of these stages are there any product revenue. They're very similar. The only difference really being that in the second stage, the company has been spending money and probably developing its technology for a while, which is not true at the first. In the second stage, the company typically has much of its management team developed. So going on to the third and fourth stages, at stage 4, the enterprise has met additional key development milestones. First revenue shipments, has some product revenue. If you look at the bullet points, those are directly from the valuation guide from the AICPA. I think the discussions with investment banks, however, of an IPO will come later than stage 4, depending on the industry. A number of our clients that are on the path to an IPO think they need to have both impressive revenue growth and profitability before they can go public. I note that there are times when this is not the case, such as in the late 1990s when people were going public with just number of page views.
Yeah, and I think you and I have talked that potentially also the financing rounds there may be later financing rounds may not occur that early in stages 1 and 2, more seed, and later rounds of financing still happening in the 4th stage. But I think the biggest thing that you point out, Dirk, is that the industry really will dictate part of the development stages. For example, some pharmaceutical companies, they're going to be talking and may not be profitable by the time they're talking to investment bankers just because of their industry.
So that brings us to stages 5 and 6. I want to note here that becoming cash flow positive is a major achievement for most startup companies, since in that case they're self-funded, so that significantly reduces their risks associated, so that they're not depending on any external financing. And also want to note that we've seen companies at these later stages of development with, or maybe at stage 4, 5, with great engineers but no sales or marketing people, where the engineers, the CEO in one particular case thought that he could sell, and these companies often have significant difficulty in generating sales and marketing. So I just want to point out those are two very different functions, the engineering development and sales and marketing. And I think stage 6 is more likely for an IPO than stage 5, at least at this time. An important part of the valuation process, both for valuing common stock and for valuing stock options, which Scott will be discussing later, is the peer group selection, the selection of the comparable or guideline public companies. You can see the different factors up there that we take into account. Additional factors would include a company's SIC code, size as measured by revenues, the certain different types of customers in the end market, and I also want to note that sometimes it's necessary to broaden the search for guideline public companies that make up the peer group, since a lot of companies are very focused, so we have to broaden that out to get to the required number of peer group companies, which we absolutely need, for example, to calculate volatility. And now we're moving on to polling question number 2.
Thank you, Dirk. And as Dirk has just gone over the 6 stages of development, we have a polling question to see sort of where you all are in your current development stage. So our question, what is your company's current enterprise development stage? A, are you in stage 1 or 2 with limited or substantive expense history? B, are you in stage 3 where you've got development near completion but no product revenue? C, stage 4, some product revenue. D, stage 5, where you have product revenue plus another breakthrough, or E, stage 6, where you have a history of profitable operations. We'll give you another couple of seconds to answer the question. And we'll close in 3, 2, 1. And I'll turn it over to Scott for a debrief.
Thanks, Debbie. So it looks like we have about 14% of you in the first stage. A majority of the participants today excuse me, are in the stages 5 and 6, so later stage companies with some profitable operations. So you're probably on the path of doing an annual valuation, which kind of fits in line with what we were looking at before, or if you still have major events going on. So we're now going to talk about, we've been talking about the stages of development. We're going to talk about a little bit generally about how the different types of equity awards that may be granted at the various types of stages. So the general types of equity awards that we're going to discuss, and there are others, companies do get creative, but stock options, restricted stock awards and units, stock appreciation rights, those are all the most common types of equity awards we see, and they come in different forms. There's time or service-based awards, performance or milestone-based awards, as well as cash-settled awards. And we see at different stages, again, very generally, certain types of awards being granted at certain types of stages. So with stock options, we really see that these are granted, they are the most common form of equity. They're granted throughout all stages. I think one of the reasons is because they're very easy to administer, and they give both equity to the employee, but then the employee also has to buy in a sense, by paying that exercise price. The downside to stock option is that they're harder to value. And we'll discuss this more later, but they require more inputs and Black-Scholes or other valuation methodologies to value them, as opposed to restricted stock, which we'll talk about in a minute. The other thing is that when you start to get even more creative with performance options, for example, they are harder to value. It becomes more difficult to determine how long that option is expected to be outstanding, and it's also harder to track, especially if you're issuing ISO performance awards, the ISO non-qual split with the $100,000 limitation rule. For restricted stock, we typically see these in early stage companies or in later stage companies. The reason being, early stage companies, you may have some founder stock, and then you get a round of financing, and typically those investors want the founders to have some sort of restrictions associated with that stock, as opposed to just being free and clear, have some skin in the game, as they say. And then later stage companies typically issue these because there is a liquidity and the ability to pay for the taxes and do everything that's needed on the administrative side in the public markets. The nice thing about restricted stock is that it's easy to value, right? Your fair market value of your common stock is going to be equal to the fair value of that restricted stock, and that's how you're going to calculate your stock-based compensation. The downside to that is that you end up with what's called a full value award, so you end up with a much higher stock-based compensation expense than if you were issuing options. And typically we see companies, you're going to have some sort of ratio, whereas you may have normally issued 3 options at a certain value, you're going to then offset that by issuing only 1 restricted stock, and the value sort of aligns in that way. The other downside to restricted stock is that it's more difficult to administer, mostly because of the taxes. With restricted stock, you have a tax event at every single vesting. So you have to be careful about when you set your vestings to occur. And then again, that goes back to having a liquid market for your participants to be able to pay for those taxes. Stock appreciation rights are definitely less common, but we do see them in later stage companies, more mature companies, and really the difference between a stock appreciation right and a stock option is that you only get the value or the shares based on the appreciation. So if the exercise price is $1 upon grant, and then later the price goes up, the fair market value goes up to $3, that's $2 of appreciation, and that's how we're going to calculate either the cash that we're going to pay out or the shares that they're going to get. And as you see here, it's most common we see these settled in cash for stock appreciation rights.
So Scott, I have a question about that. So a stock option is usually only exercised, or the company achieves, the employee achieves value when the company has a liquidity event such as IPO or sale of the company. However, it sounds like from what you're saying that when you get the stock appreciation rights, you could get value without there being a liquidity event. Is that the case?
Yeah, it really depends on the company. I mean, again, we see that more mature companies are wanting to find ways to continue to incentivize their employees, which is the whole purpose of stock-based compensation is as an incentive. And yeah, you can get some appreciation, especially if it's cash settled with those stock appreciation rights. We often see those as being cash settled with more mature companies. So now we're going to move on to polling question number 3.
Thank you, Scott. Polling question number 3 is sort of a test your knowledge question, and it should be pretty easy. It's a true or false. So true or false, the fair value of a stock option is equal to the fair market value of the common stock. A, true, B, false, or C, not sure. And while you're all answering, I wanted to remind you again, for those of you on this call for CE, you need to complete 75% of the polling questions to receive credit. So we'll give you about 3 more seconds. 3, 2, 1, and I'll turn it back over to Scott.
Thanks, Debbie. So most of you got it right, 68%, that the answer is false. So the fair value of a stock option, and we're going to touch more on this later, it is actually you have to take into account other considerations like volatility, risk-free rate, and term, whereas the fair value of restricted stock is typically equal to the fair market value of the common stock. So most of you got it right, and hopefully if you didn't, now you better understand it. We're going to turn it over to Dirk now. He's going to talk about some processes and valuation approaches.
Okay, so our next slide is just showing will show an overview of the valuation process with the different factors we take into consideration. While we're trying to get that slide up, I'll state that we can look at industry research, analysis of a company's financial statements. An important part of the valuation process is the management interview. Obviously, no one knows more about your company than you do. Here we go. And then there's methodology selection, peer group selection. We're going to go over these on slides later on, so I'm not going to say much more about these, but here is a non-exhaustive list of the factors that we look at in the valuation process. Now we'll move on to the next stage. So research and analysis, it includes looking at the general industry the company's in, the specific market the company's serving or selling into. Company-specific factors are obviously very important in valuing a company. Some of these are more subjective. These factors, subjective factors, would include the strength of the management team, the technology itself. Is it fully developed? Is it really proprietary technology that's going to be disruptive? Is it in-process technology? If so, how long until it's developed? What's the cost, and how much risk is there in the development of the technology? For later stage companies, revenue growth is a key metric. And this is the case for most companies that issue stock options. Fast-growing companies can and typically are worth much more than slower-growing companies in the same industry with similar historical revenues. Just investors are willing to pay for high growth because investors are they're looking at the past, but they're trying to predict what's going to happen in the future. Is what they really care about is future results. So the management interview will be the next slide, and we look at a number of factors in that. One of the key factors, I'm not going to go over each of those, but I want to say one of the key factors is the size of the potential market. In our experience, VCs like to invest in companies that are, quote, disruptive to current practices, and also companies that have a large potential target market. So the potential for fast growth. And Scott, I guess, has some input.
Yeah, I was just going to add, Dirk, in the management interview, obviously you're going to want our finance people, CFO, VPs of finance, but it also may, again, depending on trying to understand that industry a little bit more and the size of the market, it may be worthwhile to bring in either marketing people or salespeople, or at least some slides. Because the key thing, and we'll talk about this more, is that the valuation is incorporating the same metrics or projections or estimate of market size that you're presenting to the board and presenting to outside investors. So using board decks and things like that and providing that during the management interview or during the valuation process is very important.
Thanks, Scott. So all valuation methods fall within one of these three general approaches. The income approach and the market approach are used much more often than the asset approach for most companies that would issue stock options or have other types of equity grant awards, unless the company is in a very, very early stage, in which case we might look at the asset accumulation method. But once a company is ready to get an external 409A, they're beyond the asset approach. And we'll move on and look at the different stages of development. So up on the screen now, we're showing the different valuation approaches on the column on the left, and then the stages of enterprise development they're applicable for. So as you can see, the asset approach is just stage 1, maybe into stage 2, and then almost never used beyond that unless the company is an asset holding company, which I doubt there are many asset holding companies on the call here. Under the various valuation standards that valuation practitioners have to meet, the valuation specialist is required to consider each of the 3 approaches and then to comment and state in the report if they didn't use one, why not. So if you didn't use the asset approach, you have to explain that. If for example, you didn't use the discounted cash flow approach, that should also be explained. Sometimes that's the case for companies that are not that far along. They just have a little bit of revenue, and it's just really hard to predict. Company management does not have enough visibility to predict out. So in that case, it's appropriate to not use the discounted cash flow, but that should be clearly stated why it's not used in the report. And then if we go on to the next slide, slide before said the market approach is typically, okay, so we split off the back solve here, so that's good. The back solve is a relatively new method that, as I said before, uses the price paid for a recent, typically very recent, preferred stock financing, and it goes through the option pricing method, which is a forward-looking valuation method. And the result is that you get say the Series A price is $1 a share. From that, and the number of the company's capital structure, you can arrive at the value of the company as a whole and the value of common stock. So when there is an independent preferred stock financing, independent meaning a new lead investor, that method is typically the primary method, or one given the most weight, and that's what those numbers stand for there. 1 meaning it's the first method you rely on, 2 meaning the second one. If there is no back solve, then we do the other approaches, and we typically would do public company, M&A, and discounted cash flow for most of the companies that we work with.
I think one thing to note on the back solve, which I think is commonly misunderstood, is it's not necessarily just taking the value that a preferred investor paid, and that's your value of the common stock. So really, that's the value that investor paid for typically a preferred investment. It could be also a common transaction, but there's other methodologies that you have to, or there's other factors you have to consider, such as the preferences, the rights and restrictions of the award or the equity that that person purchased. So I'd just like to clarify that sometimes it's, oh, my investors paid $3 a share, so my common stock value is $3 a share. Typically, your common stock value is going to be worth less than that $3 a share. The other thing I think to note, as I touched on a little bit earlier, is in that the income approach, right, is making sure that we have solid projections. Dirk touched on the fact that sometimes earlier stage companies, it's very hard to predict that, and something to consider are projections being provided to the board, are projections being provided to outside investors. We want to make sure that is complete and consistent, because this is a key area that auditors look at. And so, as Dirk mentioned, sometimes we're unable to use the income approach because we can't get substantiated projections.
So the public company, M&A, discounted cash flow, the standard valuation methodologies arrive at a value of the company as a whole. That is, value of 100% equity interest. These methods here that you see, or the first three at least, are methods of allocating that company value, the business enterprise value, between the various classes of stock. So the probability weighted expected return method is what a VC, perhaps what management might think of when they think of the value of their company. This method looks at what a company might achieve in an IPO at a future date, what a company might be worth in a future sale. The discounted cash flow method looks at what the company's worth if it remains private, and then typically there's also some weight given to an unsuccessful scenario where the common stock receives zero value. So those future values are all discounted back to a present value. One thing I want to say about that is for 409A purposes, and in practice, the valuation guide and auditors don't like to see this method used unless there is a pretty good, a more likely than not probability of an IPO or a sale occurring fairly soon. So we don't see this with earlier stage companies. Certainly, if an IPO is coming up and the company's talking to bankers, then we definitely would almost always see this method. More typically, for companies where there's no looming liquidity event, is the option pricing method is used, which is a forward-looking method. You take the value of the company now, and there's two ways to look at that. One is the current value method, which is, okay, my company sells for $10 million now. I look at the liquidation preferences, the preferred stock, that's how much they get, and then the common stock gets the rest. That's the current value method. That's typically not used unless there's an imminent sale of the company coming up. What's most often used is the option pricing method, which is a forward-looking method, which, without going into too much detail, tends to place more value on compared to the current value method, or compared to how much, say, the common stock would get if the company were sold today. Using the option pricing method would give the common stock more value. So it's looking at the potential appreciation of value of the company in the future and allocating more of that to common than to preferred. And then the hybrid method, I think I talk about briefly on the next slide. So for companies, early stage companies that have received, say, a Series A financing, or where we're valuing a company where it's running out of cash and needs a financing fairly soon for its continued viability, one of the scenarios we look at, so we would use the back solve and then weight that with the failure scenario, which is defined as any scenario where the common stock receives zero value. So if it's a sale to acquire the company's employees, or any kind of sale where the value received is less than the preferred stock liquidation preferences, the common gets zero, and that's a failure. So we think that's an appropriate method. Not all valuation firms agree on that, but I think if you don't use it, you end up overvaluing common stock at an early stage of development.
I think another point to clarify or discuss is also that Dirk was talking about the OPM being that future value. So what that means really is that current value today, your common stock may be worth zero, but upon that future value, looking at the growth and appreciation, and that's really where the volatility and the peer group comes into play, that there may be some value to common. Because sometimes we get those questions, well, you know, we have so much preferred, or our common's going to get nothing. Well, there's still some appreciation built into the OPM, and that's the AICPA. That's one of their preferred methods other than the P-worm. So we're going to talk about the review process. So we've gone through and we've talked to management, CFO and marketing people, or whoever needs to be discussed. Now we've decided on methodologies based on stage of development. So now it's about the review process, and we actually send our draft valuation to the clients and want them to understand our inputs and have a chance to make sure that we're not making an assumption or there was something missed. or something's changed potentially, but that we're capturing everything properly based on our discussions and based on the company's activities. So that's a key part of the process, is to get that buy-in from management that they understand the value and how it's being derived, the methodologies we're using, but also that our assumptions, which again are mostly provided by management, that they're in line with the company's business. So the last piece is finalizing the valuation, and there's a number of steps that we'll take in this process. You know, one of the big ones is a report, right? A report that documents all of the methodologies used, industry background, the reasons, as Dirk said earlier, the reasons why we didn't use certain methodologies, and really USPAP is kind of the doctrine on this, and having a USPAP compliant report requires all of these things. And some of the common mistakes we see, because we do review other evaluation firms for our audit team, is that there isn't a report, or that it's just simply a boilerplate report, doesn't give you all the details. Really, that report should be able to, if I give this to a third party, they should be able to recreate that value and understand all of the assumptions and methodologies. Another very important piece in the process, and this, we'll touch on this a little bit later as well, about avoiding kind of future issues, is getting your auditor's buy-in on the valuation. So providing them, after you've reviewed and we've discussed, and making sure our assumptions are in line and reasonable, providing that valuation to the auditors and getting their review, letting them ask questions, if there's discussion needs to be had, having a call, and then getting their sign-off. And this may be before the end of the year, before your audit. You hopefully aren't just talking to your auditors, you know, once a year at your audit, but a little bit more often. In this case, you know, get them involved in the process. The last piece, obviously, is getting the board to approve, and getting the board to approve that audit-ready valuation. You grant your grants based on that valuation, and we'll touch on that a little bit. And you know, you're free and clear, so to speak.
So I wanted to point out two things. One, I agree with Scott firmly. It's not always possible, but if possible, have the auditors take a look at the valuation before you grant the awards. And I was recently at a presentation given by a manager in the valuation division of the IRS, and one of his main points was that an Excel file with some exhibits, so just spreadsheets only, does not meet the IRS standard for a 409A valuation, so that if the IRS comes out, audits a company, and sees that, they would not be in compliance with their code section 409A. And another interesting factor I thought the IRS manager mentioned was that they give much more scrutiny to internally prepared 409A valuations than to one done by an independent third party. And now we're turning it over to Debbie for another polling question.
Thank you, Dirk. So we're at polling question 4. So we have 2 more to go. And again, I want to remind you that you need to answer 75% of the questions for CE credit. And the question is, what valuation method is most indicative of value? Is it A, guideline public companies, B, common stock transaction and refinancing, C, guideline transactions, or D, discounted cash flows? I'll give you about 5 more seconds to get your answers in. And we'll close the poll in 3, 2, and 1. And I'll turn it back over to Dirk for a debrief.
So I see that a majority of you gotten the answer we were looking for, even though I haven't mentioned common stock transactions. We did mention preferred stock transactions, but a transaction where an independent, someone not associated with the company actually pays money for common stock or preferred stock, that is seen as the most indicative of value, because money is actually changing hands. And then the traditional valuation methods are, of course, useful after when there's no such transaction, which is often the case. And then I would say out of the remaining three, it would depend on the facts and the circumstances. For a lot of the technology companies we value, that the discounted cash flow, if the management's confident with the projections, that does provide a nice, solid, good opinion of value. So thank you.
So now we're going to get into a little bit of the granting processes. So not going to go through this in detail, definitely some takeaway points though. Equity management stems across a lot of departments, your HR, payroll, finance, legal, tax, both internal and external service providers potentially. And so the biggest and most important piece, especially around granting options or restricted stock, is documenting that process. So it starts even before you're ready to grant an award, because most companies out there are giving something to employees in their offer letter. Hopefully all of you are not stating an actual price in your offer letter, but potentially, and most people are stating a number of shares that they're going to earn at the future, board determined price. Which again should be based on the 409A value, but you want to make sure that you have controls in order to get those grants to the board minutes. So whether it's populating a spreadsheet, for every offer letter you put in, or if you're using a system, putting those grants in as pending into the system, and then when you're ready to provide it to the board, you send it to the board. Whatever methodology works for you, and we've seen some different ones, but you want to make sure, and typically it's going to start with HR, that HR people are communicating, or those offer letter grants are getting into the board minutes. And once the items do get in the board minutes, make sure that you have specifics around that. So vesting schedule and vesting dates can often be vague. And then any special terms. So if you're allowing early exercise, or you're allowing somebody a longer exercise, post-termination exercise period, you want to make sure those are explicit and called out in your board minutes. After you've had your board meeting and now you're going to grant those grants, make sure that you reconcile back to the board minutes. We've had clients where we've gone in and we found that they have never granted one or two of the grants that were in the board minutes, or alternatively we have clients that have given people offer letters with grants that they never actually got to a board meeting to be granted. People get upset about that, and they usually get upset towards a liquidity event, and even there can be legal ramifications to that. And then the final step is when you're actually going to document and present that those grants to your participants. Just make sure you provide them enough information for them to make a smart investment decision, right? So you're giving them your stock option plan. You're providing them with exercise notice. You're providing them with maybe a summary of some tax consequences. Again, you got to be careful because you don't want them to think you're a tax expert or providing them tax advice. But all of those things are good in the process. But the last thing is having your participants actually accept that award. So getting some sort of signed, or if you're doing online grant agreements, many of the systems out there today allow online grant acceptance, or even just using an EchoSign or DocuSign is a great way to automate that process, and it automates the follow-up process. Because you can have documents, we have a number of clients that have unsigned grant agreements out there. Well, what does that mean? And there's different, it's sort of a gray area. There's different kind of protocols when it comes to that. So after we've granted our grants, we now need to value our equity awards. So as we said earlier, and this is valuing them for accounting purposes for stock-based compensation. As we said earlier, restricted stock is going to be valued at intrinsic value, so pretty simple. The fair market value of your common stock, so when you get that 409A at $1.75, that is the fair value used for stock-based purposes for restricted stock. For stock options and stock appreciation rights, SARs, there's a number of methods you could use. between Black-Scholes, Lattice, and Monte Carlo. The most common, at least for time-based awards or service-based awards, is Black-Scholes. Monte Carlo and Lattice models are typically used for performance awards. Again, there's more variability or uncertainty, so you have to use more complex valuation methodologies. And the guidance really states that, and there's certain, obviously, caveats, but that if you are issuing performance options, that you should be using some sort of more complex methodology than Black-Scholes. So we're going to quickly touch on some of the variables that go into the valuation models. Fair market value at grant and the exercise price, right? Those are hopefully the same, meaning that you've granted an option at the money as opposed to in the money or out of the money. Your expected term, volatility, and risk-free rate are all going to be derived from your expected term, and typically you're going to use the simplified method. I'll get into that in the next slide. And the dividend rate is going to be, for private companies, most likely going to be 0. The key note here is that whatever valuation method you're going to use, just make sure you have it documented properly and you're consistent in applying it. So some of the differences between option valuations and common stock valuations, the key point is that we're not simply using the same Black-Scholes values. So if Dirk provides you a expected term or a time to liquidity, or you provided that to Dirk, and that's an evaluation of, let's say 2 years, and then you've derived a volatility and a risk-free rate based off of that, that's not necessarily what we should be using in our option valuation. The option expected term is typically going to be longer than your time to liquidity. Your option expected term, what that is the management's estimate of the time that the option is going to remain outstanding. So the SAB 107 is a very simplified method, but for example, a 4-year, 1-year cliff option, you'd expect that to be outstanding for 6 years based on that SAB 107 calculation. The longer expected term is going to impact your volatility and your risk-free rate, so those are, again, key inputs into Black-Scholes. However, on the peer group side, again, to get the volatility, you really should be using a similar, if not the same, peer group that you're using for your valuation. The key things that Dirk already touched on, the state, the life cycle, industry, financial leverage are all keys that you want to look at when you select that peer group. But you should be looking back and making sure you have comparable peer group between your 409A and your option valuation. The only reason you may exclude some of your 409A companies is if they're newly public and they don't have enough trading history to cover. In our case, we use a rule of thumb of 50% of the trading history. So that means if the company's only been outstanding for 2 years and you're using a 6-year term, or you're looking for companies that have at least 3 years of history to really cover that period. And that's to avoid the volatility of post-IPO or short-term volatility that you might get from shorter terms. So now we're going to move on to polling question number 5. And Debbie's going to...
Thanks, Scott. So this will be our final polling question of the webinar. And the question is, which is not an assumption used to calculate Black-Scholes? So think back to what Scott was just talking about. Answer A, fair market value of common stock. B, option exercise price. C, dividend rate. D, growth rate. Or E, volatility rate. We'll give you about 5 more seconds to answer. We'll close the question in 3, 2, 1, and I'll hand it back to Scott for a debrief.
So most of you got it right. The answer is D, growth rate is not one of our assumptions in Black-Scholes. Dividend rate, although it's typically 0 for private companies, it is still an assumption, and we have seen private companies that issue dividends. The option exercise price and the fair market value of common stock are inputs into Black-Scholes. So while the fair market value isn't going to determine our fair value. It is an input in Black-Scholes, and it's one of our key assumptions, same with the option exercise price. So now we're going to move into some of the timing impacts of valuation.
Speaking of timing, we're running out of time, so I'm going to go over these rather quickly here. So this is from the AICPA valuation guide. So according to that guide, and which the IRS also follows and expects valuations to follow, a contemporaneous valuation, that is a valuation done at the time you're going to grant the stock options, by an independent firm is ideal. And the reason why contemporaneous is that there's no existing knowledge of subsequent events in that case. A retrospective valuation can be done, but it can be biased because of hindsight. We've done valuations going back as many as 5 years when the auditor was coming through on the subject company's first audit and had questions about stock options that were granted years ago. In that case, that there was no valuation done. This was a while back. The board had just granted options at a price they deemed appropriate. Okay, moving on to the next topic.
So one of the other key impacts is on stock-based comp and potentially on your taxes for your participants. And the key things to avoid are infrequent valuations and granting options too near to the next valuation date. For example, our kind of rule of thumb is, within a month or two before your next valuation, you shouldn't really be granting options, because especially if you have a long time between valuations, how do you determine or how do you substantiate the value appreciation if, at a month ago your value was $1 and now your value is $2, unless you really have that value that's doubled in a month? How do you substantiate that? And likely you've granted cheap stock, and you may end up having to reflect different values for tax versus GAAP purposes, which is okay. But as Dirk and I were talking the other day, the IRS may start to look deeper into those issues of having the differences between tax and GAAP values. Another option is to interpolate fair market values. So that you can, again, you may be issuing cheap stock, but you may get to a value that is, again, looking at tackling some of that appreciation as opposed to all of that appreciation happening in that 1 month before your next valuation. The key thing to remember about any of the cheap stock issues is that you may have to disclose it for financial statements or for S-1 purposes, and long-term, if it's not just for GAAP purposes, but if there ends up being tax consequences, then there's potential deferred comp penalties for your participants. So we're just about at the end of our presentation, and Debbie's going to debrief us, and then we're going to try and get to a couple of questions that we have out there.
Thank you, Scott. So just a brief review of what we've talked about today. During this webinar, we've covered 409A methodologies and approaches, the stages of enterprise development and commonly associated equity awards, granting and valuing equity awards, and we've also talked about the implications of timing evaluations on equity awards. And we do, I think, have time for at least one question, so I'll hand it back over to Scott.
So we had a question asked about issuing restricted stock and having 83Bs filings. So an 83B is basically accelerating the taxes. So for restricted stock, as long as you and your participant, you handle the 83B within 30 days of that restricted stock grant, then you would be taxed on grant, and you can avoid the future tax events, meaning that if the company's price goes up in the future, you're not going to have to pay taxes on that appreciation. It would be fixed at the date of grant. So there's upsides to that. Obviously, you're paying less taxes maybe long term. The downside is you're paying taxes ahead of time in case you lose that award or you leave the company. You've already paid taxes. Same thing with immediate exercise of an option. You can also do an 83B on that exercise. You just have to do it within 30 days.
And briefly, the one last question. If a company has not yet selected their auditors, is there someone else that they need to get buy-in from? So the answer is no. I would say in that case, if you're starting off getting your 409As, you don't have an auditor yet, which is often the case, my advice would be to pick a valuation firm that has experience with both the level of auditor you think you might get, whether that be Big Four or the tier below that. So someone that has done a number of valuations reviewed by, say, the Big Four, and also to get a valuation firm that's had experience with the IRS. The IRS seems to be looking for money everywhere these days with the size of the budget deficit. So there are a few valuation firms that popped up after 409A came into existence and haven't really had their valuations challenged yet by the IRS. And I think just for a safety perspective, you might want to go with a firm that has more experience with the IRS. And that's it.
I think we can show our contact information. If there are any additional questions, we're happy to answer them. Jim, to answer your question, yes, you can issue options out of the money higher than market. Basically, you're issuing a premium option. You and I can discuss further if you want to talk more about that. Thank you, everyone. Appreciate your attendance and your great questions.